In business and finance, decision-making often involves uncertainty. Traditional valuation methods like net present value assume a fixed path for future cash flows. However, real-world investments have flexibility. Businesses can expand, defer, or abandon projects based on market conditions. This is where real options valuation and Monte Carlo simulation come into play. What are real options? Real options represent the flexibility companies have in making strategic decisions about an investment. Unlike financial options, which are traded on markets, real options apply to real assets like factories, R&D projects, and infrastructure. Examples include expansion option, the ability to scale up a project if it succeeds. Abandonment option, the option to stop an unprofitable project. Deferral option, the flexibility to delay an investment until conditions improve. Switching option, the ability to shift resources between projects. Real options help firms navigate uncertain markets and make more informed investment choices. Why use Monte Carlo simulation for real options? Traditional valuation techniques like discounted cash flow struggle to account for uncertainty and managerial flexibility. Monte Carlo simulation offers a solution by modeling multiple future scenarios and capturing the full range of possible outcomes. Monte Carlo simulation process for real options. Step 1. Define the investment model. Identify the project's initial cost, expected revenues, and cost structure. Determine relevant uncertainties, commodity prices, interest rates, demand fluctuations, etc. Step 2. Select probability distributions. Assign statistical models to key risk factors, e.g. normal, log normal, or geometric Brownian motion. These distributions help simulate realistic market behavior. Step 3. Generate random scenarios. Run thousands of simulations, each representing a possible future outcome. Each scenario reflects different values for revenues, costs, and market conditions. Step 4. Evaluate option payoffs. Apply real option rules. Expand if demand is high, abandon if losses occur. Compute the expected value of each decision path. Step 5. Compute the real option value. Compare the simulated results with a traditional NPV valuation. If the Monte Carlo valuation is higher, the project's flexibility adds significant value. Example, real options in oil drilling. Consider an oil exploration company evaluating a new drilling project. The company faces uncertain oil prices, which fluctuate over time. 1. The company estimates an initial drilling cost of $50 million. 2. Future oil prices are simulated using a geometric Brownian motion model. 3. If prices rise above $80 per barrel, the company expands production. 4. If prices fall below $40 per barrel, the project is abandoned. 5. After 10,000 simulations, the expected project value is $75 million, higher than the static NPV estimate of $60 million. Monte Carlo simulation captures the hidden value of managerial flexibility, which traditional methods often miss. Monte Carlo applications in real options. Pharmaceutical R&D, evaluating whether to continue, delay, or abandon drug development. Infrastructure projects, simulating future traffic for toll roads before investment. Energy sector, assessing investment in renewable energy based on carbon pricing uncertainty. Technology startups, estimating the value of pivoting to new business models. Challenges in Monte Carlo for real options. Complexity, requires strong financial modeling expertise. Computational power. Running thousands of simulations demands high-performance computing. Assumption sensitivity. Results depend on correctly chosen probability distributions. Conclusion. Monte Carlo simulation provides a powerful tool for real options valuation, enabling companies to make strategic investment decisions in uncertain environments. By modeling multiple future scenarios, firms can maximize flexibility, manage risk, and uncover hidden value in their projects.